Hey, what's going on YouTube? This is Richard. You're about to listen to a phone call that I'm having with some triple net lease brokers. As some of you know, I'm in the process of selling a pretty significant asset. I want to defer my taxes legally via 1031. I'm now in the process, as I have been for about 2 years, thinking about when I'm going to sell and what the replacement is. When I sell this asset, I have 45 days to identify the replacement assets, and then I have 180 days to close it. So rather than wait until I'm in contract and then start looking, I've been looking and analyzing and thinking about different sectors and different opportunities in different states and different industries for 2 years. So you're going to listen to conversation now that may be more advanced than where your current thinking is, or maybe this is where you are now and I hope you find it helpful. But either way, it's a really good use of your time because I think listening to the type of questions, listening to the responses will help drive your thinking, whether it's for a single family home, a triple net lease, a real estate development. It doesn't really matter. The more time and energy you spend thinking about questions and answers and industries and the future and real estate versus tenants versus rental income versus Airbnb, the more you start to formulate your own game plan. And that's very personal. How you act is your decision. But I think if I could see and listen to somebody that was in the same stage 5 years ago, I'd be far ahead of where I am today. And so for those of you that don't know, and we covered this again in our classes, a triple net lease is where you own the land and you have a tenant. Typically they're an investment grade tenant, corporations that you may have heard of. All these big companies, they don't own the real estate because they don't want it on their balance sheet. The accounting is really challenging for them. So what they end up doing is they lease the building in many cases, and then what's triple net lease about it is, as the owner of the building, I'm unaffected by rising tax rates, the tenant pays that. I'm unaffected by building maintenance, the tenant pays that. So I know going in exactly how much cash flow I'm going to be receiving, and that's really great, assuming that the tenant is the right quality and the industry is the right industry and so on and so forth. It takes a lot of that variability and uncertainty about, well, what if taxes go up? Well, what if the roof leaks? And it's a very hands-off way to invest. It's a very passive way. We're talking millions of dollars in many cases, and the checks just come in every single month. There's no phone calls, there's no maintenance, there's no headaches, there's no late rent. It's investment grade tenants. They pay their bills, they're running a business out of there, and they just want to keep running their business. So they handle everything else. So that's what a triple net lease is, and it's a more advanced strategy. It's larger dollars, but we should all hope to get there. Why don't you guys bring me up to speed? I've looked at that portfolio. I don't have it in front of me, and I do have some thoughts, but I'd love to hear from your perspective, whatever is on your agenda for today.
Yeah, I think the agenda for today was two things. Number one, just wanted to see if we're getting closer. I think we turned up the heat a little bit in terms of getting a little bit more aggressive, and we did throw in one opportunistic deal just to kind of take your temperature and see what your thoughts were. Did not get overly aggressive. We could turn it up a little bit, but your cash flow has definitely gone up from the last portfolio. I think it's up $40,000 from the last one we showed you. We didn't take much more risk at all. And we also gave you an opportunistic deal with a short-term lease that allows you to exit in 24 months with a substantial profit. So that's number one. And then number two, just wanted to obviously see if we're on the right path here and, just better understand if we should do another portfolio and stay on this path.
Yeah, okay, cool. So I kind of like the opportunistic deal, but then I also wonder, if it's worth more and it's generating more cash once they do the renewal, if it's not also just a good buy and hold. What are your thoughts on that?
Yeah, it could be, and that, just to bring you up to speed, I know you don't have it in front of you, but that was a Pep Boys in Tallahassee, Florida, and it sits in front of a Lowe's and a Publix. It's very well located, and it was only about $1.5 million price point. We think we can get it for $1.25 million. If you were to buy it and hold it, you're doing really well. But I think in that market in 24 months, if what you're forecasting and what we're thinking is correct, you're probably going to be in a little bit of a higher cap rate atmosphere. and you can probably afford to sell it with a decent profit, do a 1031 exchange, and probably transition your capital into something else, maybe more opportunistic, and do it again. Do the exact same thing again.
Right.
So repeat that process, create more value, buy a bigger building, and do it a third time. And, that's just one property out of 5 that we showed you. The sectors are broken down into auto service. So we have Caliber Collision, which is, they're the largest collision and auto repair company in the country. They actually just got the contract to do Tesla now. So they sub out Tesla work, and Tesla is known and they're infamous for only allowing Tesla dealerships to do their own collision work. Caliber just got that award. So that's great. We have a Pepsi distribution facility. They have a 98.1% renewal rate. It's a bottling facility. They bottle Pepsi soda, and then they distribute it. That's in Michigan. We have a hospital with a substantial corporate guarantee, and it's exactly what we talked about last week. It's in Winter Park, Florida, which is a wealthy suburb of Orlando. I think that's probably my favorite deal in the portfolio. It's 20 years, corporate guarantee from a regional hospital, and this is their outpatient facility where they do lab testing and general checkups and x-rays and things like that.
That's a public company, right? Because I looked at I tried Googling what you called it in the spreadsheet. I didn't have any of the deals attached, so I couldn't really I was hoping that I would either have the PDF deal sheets or a hyperlinked clickable so I could learn a little bit more. But I Googled what you called it on the spreadsheet, and some other public company came up that operates surgery centers, and the stock was trading at like $120 a share. Is that the same company, or is it a different company with just similar HCA?
Yeah, that's the company.
Okay.
HCA is Hospital Corporation of America, and it's a global company. They've got 178 hospitals. They're headquartered in Nashville. They've been in business for 50 years, and they are public, and it's a for-profit operation. So in terms of your other question, those hyperlinks are all active. You can click on any of those.
Oh, really?
Take you to the, yeah.
I was trying. I don't have Excel. I use Google Docs. I'll try it again.
Oh, okay.
But
yeah, give it a shot. And Aaron, why don't you send him just copy and paste those hyperlinks to Richard?
Yeah, that'd be great. So,
but yeah, so that's the blend. And then we have a convenience store in there in Austin because we love the land. We think that Austin's great. It's tax-free. The land is phenomenal, and we think that, in 15 years' time, that it'll be something more than just a convenience store in the event that they ever left.
So let's talk about that, and then I just want to transition over to the auto for a second. So one of the concerns I have with these convenience type stores with gasoline is environmental.
Okay.
So when you talk about this thing transitioning in a few years or 15 years or whatever into something else, how toxic are these gas stations to the soil and environmental, and how big a deal is that? I know remediation can occur, but it's super expensive.
Yeah, no, absolutely. And I think it's a good question. It's probably more so a concern on older stations. Your chance of a leak with these new stations is very, very low. It's like almost non-existent. It really never happens. There's new types of tanks that they're using now. A lot of them are using above ground. In this case, for Quick Trip, they're using an underground tank system, but they're double insulated,
right,
reinforced insulation tanks. Actually, they're triple insulated. I'm sorry. And I mean, I haven't heard of a spill out of a Wawa or a Quick Trip or any of these newer stations in probably 10 years. And we've taken some of these back after the lease expired, and even the ones in the early 2000s, that's when they really started to do these metal, and they're doing metal now. They're not doing the fiberglass ones. So that's the first part of it. The second part of it is this is actually a ground lease, and the lease provides for a provision where if there is any sort of spill, catastrophe, or leak, Quick Trip must indemnify you until the situation is resolved.
Okay.
So there's a damages clause in there that protects you specifically with Quick Trip and with Wawa and 7-Eleven. Sometimes it's subjective. Lease to lease, it's gonna differ. But again, I can't tell you a lot. I mean, yeah, the stations from the 60s, 70s, 80s, 90s, you definitely see some problematic stuff. But mid 2000s onward, very rare to see it unless you have like an amateur operator who came in and, as a franchisee.
Yeah, no, I'm less worried about the actual spill and damage. I'm just more worried about resale. So like I've looked at a lot of commercial properties, excuse me, in and around the Bronx and Brooklyn, and environmental is just always a concern. And there's some deals that we just passed on because like we just didn't even want to get involved in the headache. So if you're telling me that there's an active market for these convenience stores, people buy and sell them all day long, which I would imagine is the case, I'm less worried. But I just don't want to be holding something that, year 12, I decide I want to exit, and it turns out that, there's all these environmental concerns, and we really should have talked about it 12 years earlier.
Sure. Yeah. No, I get it. I completely understand. I think that I don't see it as a huge concern. Maybe it's because I'm so deep in the market, and this is kind of all I see, and I've answered this question maybe 50 times. It doesn't mean that that doesn't mean it's not a valid question. It's a very good question, and it's one that many smart investors ask. So I think that deal by deal, these things are going to vary, and the two things you want to really focus on is what kind of tanks did you use, and are they underground? And number two, what is the protection that the tenant offers me within the period after they leave? Like in 20 years, let's just say that Quick Trip leaves, you may find out about a spill 5 years after they leave, in the middle of you building an apartment project in Austin. That's not something that you signed up for. So the lease actually also provides a period of time after they leave for which you can actually seek the same indemnification. So
Got it.
Not every lease is going to do it, but Quick Trip does it, Wawa does it, and 7-Eleven corporate sometimes does it. BP also does it. But again, not everybody does it.
Okay. And then I was thinking about the automotive industry, and I know that we have to take some risk, right? There's no such thing as a really good risk-free deal, so there's definitely risk. But one of the things that I was thinking about automotive, if you put your Elon Musk visionary sort of hat on, is that the likelihood that people continue to drive as much in the same manner going forward is reduced. With the advent of Uber, and then when people become like driverless cars and they're just Ubering all around in self-drive vehicles, and there's fewer accidents and so on and so forth. Again, I don't think this is in the next 5 years or even 10, but I think from a 20-year hold or 30-year hold, collisions are going to be way lower. Pep boys needing parts and auto repairs and stuff like that. So it might be maybe what we do is we view that as an intermediate hold, but I just don't think I want to buy and hold that and pass that along to generations, because I think that becomes extinct.
Understood, and it's a good point. I think a lot of that just kind of stems back to what your belief system is in regards to where the sector is going. Everyone's got different opinions, and we certainly acknowledge that. So my thought on this is, if you're going to go into the auto sector, you're either going into it for one of two reasons. Number one, you believe in the real estate, right? And you think that despite whatever's here today, the real estate's going to be worth more without the auto company on it. And that's how I feel about Quick Trip. I think that you're sitting on basically the out parcel of the Dell headquarters, and you're probably one of the best retail markets in the entire state of Texas. So that's definitely one of the major bonuses. So I think that automotive or not, that falls into the real estate category. And in terms of caliber and why that works, I think this is the second part of it, is you either buy it for real estate or you buy it for yield. So maybe the yield on caliber is not high enough, and maybe what we do is we kick that out, because it sounds like your belief system over 10 or 15 years is leading you to perhaps take the precaution that collision won't be as relevant a subject. So if that's the case, then 6.5% yield is probably not enough for you to take the risk. You might want to be at like 7.5. Maybe then your conversation changes.
Yeah, but I also think, at the end of the day, I'm a real estate investor and I'm buying real estate. So I much prefer to buy prime real estate versus prime tenants.
Sure.
Right? And I think that the consideration should just be, what's the time frame I'm holding this? Because look, I can make negative biased arguments on everything, right? Retail goes away, self-drive, no Pep Boys. Like, then all of a sudden I'm not buying anything. There's like nothing to buy, So
Yeah.
I have to buy something. And that's the whole point of the 1031. I'm not interested in paying taxes. I'm going to defer. So I have to pick like the least beautiful date. I'm sorry, the most beautiful ugly date.
Yeah. Completely understood. I think it's a moving target, and I think, if you're looking at it in the way that you are, it's an intelligent way to look at it. And I think what you're saying is you don't want to overly optimize and just, kind of deliberate as to what's the best option for me. I think that you're going to find a lot of really, really good ones out there, but deals like Hospital Corporate America, deals like that are not going to come around every day. So things like that, like when those come around, you can say absolutely yes. I think that makes a ton of sense to have in my portfolio. But I believe that you're asking the right questions. I think that if I were to remove something out of what you just told me, I would probably take the caliper collision out. Probably just because I don't think the real estate falls in line with what your investment strategy is. I still like the Pepsi. I think it's well located. I still like the hospital. Quick Trip is a gas convenience site, but it's a phenomenal piece of real estate.
So,
I think that
okay, so I'm okay with that. And then what about the Pep Boys? That's just a flip. So the automotive services, unless the whole world sort of starts to shun automotive service, like they're starting to shun retail.
Yeah. Well, I think that piece of real estate is highly valuable. It's sitting in front of a Publix. I don't know if you've heard of Publix.
Yeah, sure.
Yeah, so Publix is in Florida, dominant grocer. It literally sits in front of a Publix parking lot, and next door to Publix you have Lowe's, Home Improvement. Lowe's is next door. So this property basically sits between the two of those in the front parking lot. I think the piece of land is phenomenal. I think you have a big corporate guarantee from Pep Boys here. They just renewed, they've committed to renewing the site, meaning they said, hey, we have only 6 years left, but we'll stay here. Do you want to make a deal? We said, hey, we're the brokers. We're not going to make a deal with you, but maybe we can find somebody who will make a deal with you. And they said, okay, we'll stand by. So that's why we're bringing it to you. They have 6 now on the lease. They're willing to go to 10. It could be a flip. It also could be a hold.
Right.
The real estate's attractive, so it can go either way. But I think that my confidence level lies in the fact that despite it being a Pep Boys, you're buying the land and the building with Pep Boys cash flow for $1,257,000. The land and the building without Pep Boys is probably worth like $1,500,000, and that's today. So in 10 years, with inflation and rent growth, that probably can continue to increase. So I don't think that having Pep Boys is relevant in conversation, but it does help because there's some cash flow there, and it's high. It's like 8.75% cash flow.
Cool. Okay, well, yeah, so I think what I'd like to do is take a look at the links that Aaron's going to send to me.
Yeah, I just sent it to you, actually.
Okay.
Yeah, they should be in your inbox already. Preacher sent it.
Cool. So I'll look at them between now and our next call. But I think we're on the right path. I love the fact that we've got a really diversified portfolio by industry, by geography, by tenant quality. So we're starting to get closer to what we're looking for. And just to give you an update on my place, we've had a family come and do a second showing. They haven't submitted a bid yet. We're unsure whether they will or they won't, but we're obviously hopeful that they will. My broker who was there said that they were very positive on it. I think that the wife really liked it. The kids, who are basically young adults, really liked it. They were looking at another property on the Upper East Side of Manhattan, and the younger kids don't really want to be on the Upper East Side. They'd rather be downtown. And the one that's sort of cooler on the whole situation is sort of the husband. But I understand that they're like, I don't know, some family dynamics, maybe separating or are separated or something like that. And whether they're separated or they're together, I don't know about in your family, but I can tell you that in my family, in my prior life in particular, you know, my wife and my kids sort of rule my decision making, you know? So we've got the right people advocating for it.
Yeah, well, that's good.
So
that's definitely positive motion. That's amazing.
Yeah, so we've got some good feedback, we've got some good opportunity. We continue to show it, but you know, I don't have anything more concrete to tell you, and I'm just trying to manage your sort of timing and expectations a lot as best as I can, and just be really transparent with you.
Yeah, no, we appreciate that. What we'll do in the interim, I know you're down in the Outer Banks. That's great. Do what you got to do. Aaron and I will come up with another model for you.
Great.
And we're going to tweak some things around. Let me pull this caliber out, and let's show you another example, maybe without caliber, and maybe we'll replace Quick Trip with something else and just see how you feel about it, and then we can compare the two models and see what you're more comfortable with, okay?
Terrific. And I really appreciate your time, and I think we're getting close.
Yeah, absolutely. Same here. We hope you have a good trip, and we'll talk to you soon, Richard.
All right, gentlemen. Thanks so much for your time. All right, so I just had a great phone call with them. I really like the way that we're advancing the portfolio. I have weekly calls with this team. They propose new portfolios every single week, and we just keep iterating. And that's one of the advantages of starting really early, is I've gone through multiple different teams. I've spoken to multiple different brokers. I've had a lot of different analysis. Now I'm sort of circling around the same team because we're communicating intelligently. I like what they're showing me. I like their feedback. And as always, picking the right brokers and the right team is critical. I can't go out and source these deals on my own, nor do I want to. But if I can express to them and develop trust in a communication via a relationship, they'll go do their best, they'll do their work, they'll present it to me. And as you heard on the call, they're going to iterate, they're going to take one out, put a different one in, and we'll have another call next week. So it's an investment of their time, but I'm a pretty good client. This is a pretty large transaction. And it's an investment in my time in working on it now, long in advance, but I'm going to get really compensated for that in the way of higher returns and less risk and a highly diversified portfolio. So for me, there's no better use of my time. Charles and I are sitting here filming. We're talking about the Outer Banks development project. I had this call scheduled, and I said, this is really important. I must take this call. Again, I don't even have anything under contract, but that's how strongly I feel about it. And I said, in fact, it's a really good opportunity for people that are either in my classes or want to be in the classes or want to get the triple net lease or whatever, to learn about sort of the next level of real estate investing. So I hope you found this helpful. If you did, thumbs up, really appreciate it, and also subscribe.